Forex trading might sound complicated, but it's simpler than you think. It's all about buying and selling currencies. Imagine going on vacation and exchanging your dollars for euros. That's a basic Forex transaction. In the massive world of Forex, you're not just exchanging vacation money, you're trying to make a profit by predicting whether one currency will rise or fall against another. It's like betting on your favorite sports team, but instead of teams, you have currencies. Millions of people and companies trade Forex every day. It's the world's largest and most liquid financial market. With trillions of dollars changing hands daily, there's always an opportunity to buy or sell. Think of it like a giant global flea market, but instead of antiques and collectibles, it's currencies from all over the world being traded. And just like any market, the prices of these currencies fluctuate constantly. When you buy one currency, you're simultaneously selling another. The goal is to profit from the expectation that one currency will strengthen or weaken against the other. Forex traders often use terms like pip and leverage. A pip is the smallest price move that a given exchange rate can make, usually measured in decimal points. Leverage allows traders to control a larger position with a smaller amount of money, amplifying both potential gains and losses. Now let's talk about the lingo. Currencies are traded in pairs, like EUR-USD, Euro-US dollar. When you trade Forex, you're speculating on whether one currency in the pair will strengthen or weaken against the other. You'll often hear the term pip. A pip is the smallest price move a currency pair can make. It's like the tiny tick marks on a ruler but for currencies. Even small pip movements can mean big profits or losses depending on how much you're trading. And that brings us to leverage. Leverage is like borrowing money from the market to amplify your trades. It's a powerful tool, but it can magnify both profits and losses. Imagine using a lever to lift a heavy object. It makes the task easier, but it also increases the risk of something going wrong. So, how does a Forex trade actually work? Let's say you think the euro will rise against the US dollar. You would buy the EUR-USD currency pair. If your prediction is correct and the euro strengthens, you sell the pair at a higher price, making a profit. Of course, it's not always that simple. The Forex market is influenced by a complex web of factors, including economic news, political events, and even natural disasters. That's why it's crucial to stay informed and understand the forces that can move currency prices. Most trading happens online through Forex brokers. These brokers provide the platform and tools you need to analyze the market and place trades. They also offer leverage, allowing you to control larger positions with a smaller amount of capital. Before you jump into the exciting world of Forex, it's essential to start slowly and learn the ropes. Begin by educating yourself. There are tons of free resources available online, from articles and videos to webinars and online courses. Once you have a basic understanding, consider opening a demo account. A demo account allows you to trade with virtual money, giving you a risk-free environment to practice your skills and test different trading strategies. Remember, Forex trading involves risk. It's not a get-rich-quick scheme, and losses are part of the game. Start small, manage your risk carefully, and never invest more than you can afford to lose. With patience, discipline, and a willingness to learn, you can navigate the exciting world of Forex trading and potentially achieve your financial goals. If you found this guide helpful, don't forget to like and subscribe for more beautiful free content like this.